Before we start, two things, okay? First, this afternoon, as I put two news announcements on Cloud Deacon, as you can see. In this afternoon, I will have 2 Cloud Lab sessions to answer your assignment 2 questions, okay? So basically, those Cloud Lab sessions are prepared for off-camera students, but you guys are welcome to join as well. Yeah, they will be recorded. The live session will be recorded. If I remember, I need to click the recording button. But do you have class from 6:45 to 7 in the evening? Oh. Oh. Then I thought I have 2 sessions. I put a time on 6:45. That's what I thought most of the students should have time. But this will be recorded anyway. So basically, how are you going to join? Let me think about it if there's a lot of students have class. But how are you going to join? It is very easy. You click resources, and then you should have something called Cloud Classroom, right? You click Cloud Classroom. You click the Blackboard Collaborate Ultra, and you're then able to join the room. You just need to click unit, and then you're able to join. Once you join, you can type your question. All right? And you will see me, I will answer your question. But you can only type the questions. Does this make sense for you? And the whole session will be recorded. So if you want to join the session, make sure that you have your question be prepared. So you can answer me during the session about your assignment 2 only. And it will be recorded, okay? And I will probably try to see how many students actually have class in the evening. If there's too many students have class in the evening, I'll try to arrange another time. But otherwise, I have to do it in these 2 sessions, though. Okay? All right. For this week's seminar, the second part of risk and return. So before you break, we talked about the relationship between risk and return. Specifically, we talked about how to understand or how to explain return in dollar term and percentage term, right? And further, we've discussed about the risk. And specifically, we talked about how to estimate risk. And I told you guys, which I show you guys, risk is more like the movements of up and downs, right? Higher risk means higher volatility. Higher volatility means higher risk. To this end, if you want to measure risk, all we need to do is to figure out the movements, up and downs, of the certain financial assets. The higher the deviation from its average, the higher the risk. Variance is the squared deviation. Standard deviation measures the deviation from its average. So that's the whole idea about how we measure risk, statistically. By doing this, we actually worked out total risk of a financial asset. But total risk comprises systematic risk and unsystematic risk, right? Systematic risk is the good risk. Unsystematic risk is the bad risk. It is the systematic risk that gives you return. So the risk and return relationship only hold between systematic risk and the return. So that's the risk and return relationship. The unsystematic risk is a bad risk. Unsystematic risk, it is nothing to do with your business. I use a very strange example. I said, okay, think about my example. My dog, unfortunately, died in the morning, so I may make stupid decisions. This kind of risk is unsystematic risk. This kind of risk is nothing to do with your business. And this kind of risk can be eliminated. How? We can eliminate such risk by using portfolio diversification. As long as you are using portfolio investments instead of investing in individual assets, you will then be able to eliminate this unnecessary risk. For example, what about if you invested into 30 companies in this industry? To this end, you then able to eliminate the unsystematic risk of a particular company. Am I right? Unsystematic risk can be eliminated. Unsystematic risk is nothing to do with your business. Unsystematic risk is the bad risk. To this end, unsystematic risk is nothing to do with return. High unsystematic risk means nothing. Does this make sense for you? So that's what we've learned 2 weeks ago, risk and return relationship and how to diversify risk. Now what are we going to do this week? For this week, first of all, we will learn the risk-based approach to estimate an asset expected return. Specifically, we want to estimate expected return. We want to understand the relationship between risk and return, specifically the relationship between risk and expected return. Because we do not want historical data. Finance is about investment. Am I right? So we want the relationship between risk and your expected return. Second, we will describe how to measure systematic risk. Now, intuitively, if you want to identify the relationship between risk and expected return, you, first of all, need to identify the systematic risk, because only the systematic risk will affect your expected return. Am I right? Last week, we talked about how to measure total risk, standard deviation, right? But this week, we need to identify how to measure systematic risk. Do not get confused, okay? So last week, we learned how to measure standard deviation. And this week, we want to learn how to measure systematic risk. Now, we will then talk about portfolio return and portfolio risk, which is a relatively easier topic. How to work out portfolio return and risk. Generally speaking, as long as you know the return of individual assets and the risk of an individual asset, together with the weight of the assets, you will then be able to work out portfolio return and risk, which is very easy. And then we will talk about the great capital asset pricing model. The first asset pricing model in the literature can be used to work out the expected return. In your second assignment, the last part asks you to do a literature review. One of the literature review questions is asking you to work out cost of equity and propose the method. Cost of using equity is the same as expected return in this unit. They are interchangeable. To this end, CAPM could be one of the models that you can apply for the second part of your assignments. You can use CAPM together with someone else. Alternatively, you may have 2 other methods to estimate the expected return. Methods such as arbitrage pricing model, Farmer French 3-factor model, Cahard model, stuff like this. But you do your own research, okay? Now, at the end, I will spend about 10 to 15 minutes to give you some concept about market efficiency, efficient market. What is the efficient market, and why do we want the efficient market? Under efficient market or semi-efficient market, what happened? Okay? So that's the whole idea about the learning outcomes for this week. All right. At the very beginning, in practice, your decision must be based on expected return. Please note that expected return is something about your expectation. All right? If you want to make a financial decision, you have to make your decision based on expected return. Am I right? Well, from accountant's perspective, historical data means something, but historical data is not everything. Am I right? You may be able to observe a trend from historical data, and then use such a trend to estimate expected return. Just like what you did for your assignment. You observe the growth rate, then use your growth rate to estimate next year's dividends. But you can't simply apply previous data to make your financial decision. Am I right? So return in finance means expected return. Now, expected return, we need to learn the method that can be used to estimate expected return. The first method is more like an accounting method. It's called historical method. Historical method, very easy. You basically use historical experience to make your decision. That's it. For example, the year before your expected return, the year before your company's return is 10%. Last year, your company's return is 10%. So this year, your company's return or expected return will be 10%. That's historical approach. Purely and entirely based on historical data, that's it, without considering other factors. Please note that in other methods, we will still use historical data, but we are trying to identify the relationship. But historical method itself only consider historical data, that's it. Get it? So I don't want to spend time on this method because this is not our focus. The second one, probability approach or probabilistic approach. It is more like an economic approach. So if you study economic units, that is the method they will use. For example, what is the probability approach? Very easy. You may have two probabilities. There is a 50% probability, 50%, that next year your return will be 20%. There is a 50% probability that your next year's return will be 10%. Then what is your expected return? 50% probability times 20%, plus 50% probability times 10%, which will be 15%. That is the probability approach. Probability times corresponding return. Sum it together. Does this make sense for you? This method is quite popular, especially in economics. We recommend this is the best method. But the issue of this method is it is very hard for you to determine the probability. In my example, I only give you two probabilities, right? But there might be 1,000 probabilities about tomorrow. So you need to consider each of the possibilities together with its respective return. So the estimation is very complex. So econometricians, they were probably going to do this in this approach by using advanced economic model, which is very complex. All right? So in RBA or in the government, this is the approach that they are using to predict or forecasting the future economic condition. That's how. All right? But it's too advanced. It's nothing to do with us. Now, what about us? We focus on the last approach, the risk-based approach. The risk-based approach, we are trying to identify or estimate or at least understand the expected return by considering the relationship between risk and return. We are trying to estimate expected return by using the underlying risk. So we're trying to identify, step one, the relationship between the risk and return. And step two, estimate its return. Does this make sense for you? So finance method, we are trying to identify the expected return by considering its risk and return relationship. And that is the finance approach. Okay? That's how we're going to do this question. Do not get confused. In this finance approach, we will still use historical data. But we're using historical data to identify the relationship and then use the relationship to to estimate expected return. Get it? So that's the difference, all right? Accounting historical data approach is purely based on historical data. They are not trying to figure out any kind of relationship. There's no right or wrong. Their method might be right. Okay? Now, before we move to the last method in detail, sometimes students will ask me, "Hey, Robert, which one is the best method?" Sounds to me the economic method is good. The finance method is good as well. Looks like the accounting method, historical data approach, is not good. In fact, it's not. I'll give you guys a classical example. It is really hard to say. One of the classical example is about the weather, temperature. You guys know that we are always trying to forecasting the temperature, right? The weather. There's many different models. Economic model trying to forecast, or statistical model trying to forecast in temperature. But the best method in practice is actually the moving average. All you need to do is to take the average of the past 5 days. The estimation is even better than the advanced model. So sometimes it's really hard to say. So for example, if you want to know tomorrow's temperature, instead of using a very complex model, but analyzing past 30 years data, you probably just need to take a simple average of the past 5 days. That's it. So it's really hard to say. There's no right or wrong. But we are just trying to explain expected return from the risk perspective. That's our job. Okay? I'm not trying to say our method is better. But in finance, that's how we explain the risk and return relationship, trying to understand it. That's the first thing that I would like to share with you. Second, in finance, we are trying to understand the return and risk relationship. We are trying to understand the relationship between risk and expected return. We are not trying to forecast future returns. In finance, we believe no one can predict return in future. Okay? So there's no such a thing called forecasting in finance. But for econometricians, they do forecast every day. So that's the difference. There's no such a thing called forecasting in finance. You can't forecast tomorrow's return. We are just trying to explain the relationship. That's why there's a risk-based approach. If you have these 2 points in your mind, now let's move to the risk-based approach. Generally speaking, think about it. We've talked about the risk and return relationship. High systematic risk, high expected return. Low systematic risk, you will expect lower return, right? The risk and return relationship only hold between systematic risk and expected return. Let me say it again. High systematic risk, you will expect high return. Lower systematic risk, you will expect low return. To this end, intuitively, for a financial asset, as long as you are able to estimate a systematic risk based on historical data, you then should be able to work out its expected return. Am I right? Or at least be able to explain its risk and return relationship. Do you agree? Intuitively, right? But what happened is, in the past many years, none of us till today, no one can estimate systematic risk. Why? Last week I told you guys, we can work out total risk, standard deviation. And we know total risk have 2 components, systematic risk and unsystematic risk. And we know that by diversification, we can eliminate the unsystematic risk. But what we don't know is to what extent. We have no idea about systematic risk. We can't measure systematic risk. If you want me to tell you what is the exact value of the systematic of the risk asset, I don't know. And in practice, no one knows. To this end, you cannot estimate systematic risk directly. Then what should we do? To this end, we decide to do something indirectly. We decide to use a 2-step process. Ooh. The first process, we measure systematic risk of the asset and then use systematic risk to compute expected return. But how to work out systematic risk? We decide to use market return. Now, the logic here is very simple. Listen carefully. I'll say it once, and then we move to the example. Assume today there is a financial asset A. Assume today I have the market. I have the entire market. For this entire market, there is a market index, which is the market return. If you do your assignment 2, do you have something you want to talk with me? Do you want to talk to me? If you have the market return, from your assignment, as you can see, right, I ask you to work out the market return on the stock exchange. Am I right? For example, if you want to know the market return, you go to yahoo.com. You then able to work out the index return. The index return of AXX 300 standing for the return of the market. The index AXX 300 return of the market comprise all of the financial assets in the market. Am I right? So for example, if you talk about AXX 300 index, this is a market index comprise all of the shares in the market. If this is the case, for this market index or this market portfolio, it must be well diversified. Do you agree? Do you agree? It must be well diversified. Do you guys agree? Because you have 300 shares in the portfolio. So for this market portfolio, there's 0 unsystematic risk. Am I right? So for this market portfolio, you will only have systematic risk. Do you agree? Am I right? Now the logic itself is very simple. If this is the case, okay. This is our market. Let's set its systematic risk equal to 1. So we just let it equal to 1. We give it a number. Let's set the market systematic risk equal to 1, which is called market beta. We let it equal to 1. And you have the market return. Am I right? And then you have the underlying financial assets. Let me ask you a question. If market return is 10%, which means for 1 unit of systematic risk, it will give you 10% return. Am I right? If your company's return on that same day is 20%, what is your systematic risk? Let me see it again. Let's set market systematic risk equal to 1. If market return is 10%, which means for 1 unit of risk, it will give you 10% of the return. Do you agree? Now, based on the historical data of your company, your return is 20%. Then what is your beta? What is your systematic risk? Must be 2. Am I right? Because you have 20% of the return, so your systematic risk must be 2. And that will be the beta of your company. We are using beta to work out the systematic risk of the company. Beta is a relative risk measure. Your systematic risk relative to the market. We have no idea about your systematic risk. Am I right? To this end, what we decide to do, let's work out a relative risk measure. As long as you know market return, as long as you know your return based on historical data, you're then able to figure out your beta. Does this make sense for you? Any questions? Okay, second example. If based on historical data, market return is 20%. Market return is 20%. Based on historical data, your return on average is 30%. Then what is your beta? 1.5, isn't it? Because in this case, 1 unit of systematic risk will give you 20% of the return. Do you agree? To this end, 30% means your risk or beta equal to 1.5. Does this make sense for you? Your company is 1.5 times riskier than the market. Do you agree? So that's how we work out beta. And that's the first step. Up to this stage, about this step, any questions? Now, some of you guys may be wondering, hey, Robert, if this is the case, in practice, so your example is very straightforward, right? In practice, how do we work out beta? Very easy. In practice, you download the data from the market, from Yahoo.com or Morningstar. What happened is, for the first column, you will have a list of past returns of the market. For the second column, you will have a list of past returns for the assets. You then run a linear regression. You run a linear regression, the slope is your beta. Because the slope captures, or the coefficient captures the relationship between your returns and the market. Does this make sense for you? Now, I'll prepare a simple example for you. You don't need to worry about this in your exam, because in your exam you can't do it, you don't have Excel. I just want to show you how to do it in practice. So what do you need to do? If I open this Excel, let me enlarge it. Who? Oh. What should I do? This. Okay. A is your past return, historical data, okay? Past return for asset A. Column B or column C is a market return. As you can see, it looks like at any given point of time, the return of A is always higher than the market. Am I right? Which means what? At least you know A has higher systematic risk than the market. Do you agree? But you want to know A systematic risk. What should we do? Let's set the systematic risk of market equal to 1. We run a linear regression. The coefficient slope of the regression will be the beta for A because it captures the relationship between return of A and return of the market. What to do? You go to Excel, and sometimes you may need to go to options, and you need to add in the data analysis true pack. So which is analysis true pack. You need to go to there to add in something. All right, this is more like a setting for your computer. But once you have the analysis true pack, you can go to data, and you have data analysis. Once you have data analysis, I can't enlarge this. You can click regression, and you click OK, and you choose input Y as your A, and input X as your market. And you have labels, and then you click run regression. I probably need plots, line fit plots, yeah. And then you click OK. So by doing this, you will have a relationship between the market and the asset. Can you see that? I make a very simple example because it's a very obvious relationship, right? A linear relationship. Now, in this relationship, there is a coefficient measure. This coefficient measure, 2.32, is your systematic risk of the asset. Which means, if you look at the result here, which means your risk is 2.32 times higher than the market. Does this make sense for you? And that's how we work out systematic risk in practice. Okay, by using a linear regression. All right? Again, this part is not examinable. I just want to show you how. All right? Yes. It doesn't matter. I will let you know. I'll let you know. You have to, it's a very good question. So what he's asking me, if you talk about the market, are you talking about the collective market, or if you go to airline, you only consider the airline business, the industry? It doesn't matter. It depends on how you define your market. In most of the case, if you do research, for example, or analysis in Australia, you will only consider Australian market. And the base, you're asking the base, we're using as considered as the market is most likely will be ASX 300. But of course, if you're doing a mining project, you talk about mining companies, the market for you is only mining market is relevant. You probably only consider mining, all right? But you need to have a market. The whole idea that we have a market is because of that, we know the market portfolio is very diversified. And that's why we can set its risk equal to 1. Am I right? That's the whole idea. Sometimes students come to ask me, hey Robert, why we have to use a relative risk measure relative to the market? Why can't we use a relative risk measure relative to another asset? You can't, because for another asset, its risk comprises total risk, systematic risk and unsystematic risk. You can't. The reason we are using market is because we all know market must be well diversified. Am I right? So there's zero unsystematic risk. Whatever risk left in the market must be systematic risk. If you have 10% of the return from the market, which means 1 unit of systematic risk give you 10% of the return, that's for sure. If you have 20% return from the market, which means 2 units of systematic risk give you 20%. Does this make sense for you? Am I right? Of course, we will have slightly more complex version in the next 20-40 minutes because we need to consider risk-free rate, but that's the general idea. Okay, so from my regression analysis, as you can see, you can work out the beta, which is about 2.32. Now, let's move back to your slides. The risk-based approach, step 1, you need to measure systematic risk of the asset. So step 1, by doing or using the regression method, we are able to work out a systematic risk of the underlying assets, the coefficient. Does this make sense for you? Now, please note that in this approach, the systematic risk is named as beta. In this approach, the systematic risk is named as beta. So beta for the market must equal to 1. Beta for the underlying asset means your systematic risk relative to the market. It is a relative risk measure, not absolute measure. Get it? If your beta is 2, it does not mean that your absolute risk is 2. It is a relative risk measure. Your systematic risk relative to the market is 2. That's it. Get it? And that's the approach. Now you guys may be wondering, hey Robert, once we have beta of the asset, then what should we do? Let's see the relationship. Generally speaking, the beta measure captures the proportion movements in the stock returns relative to the return on the market. By definition, the market beta must equal to 1. Second question, if there is a stock or share, the stock's beta is equal to 1 as well, it means what? This stock has the same risk or systematic risk as the market. Third question, if the stock have beta higher than 1, means what? It has higher risk than the market. Lower than 1 means it has lower risk than the market. Last question, what about if the stock beta equal to 0? It means what? If the stock beta equal to 0, which means your systematic risk relative to the market is 0, which means your systematic risk must equal to 0, because 0 relative to everything is 0. Or 0 divided by anything is 0. Am I right? So beta equal to 0 means no risk. Question, what kind of financial asset has 0 risk? What kind of asset have 0 risk? Risk-free asset. For example, Australian government bond. So Australian government bond, you can assume its beta equal to 0. In practice, it's not really 0. It's like 0.00.1, something like this. It's not exactly 0. But you can assume it is equal to 0. All right? In practice, we do have exceptions. Sometimes there's negative beta, but you don't need to worry about negative beta. It's more about hedging and speculating. Okay? Now, if, for example, second paragraph, a stock has a beta of 1.4, it means what? As per discussed. It means if market return increased by 1%, your stock return must increase by 1.4%. If a stock has a beta of 0.4, which means market return increased by 1%, your stock return will only increase by 0.4%. Does this make sense for you? Any questions up to this stage? Any questions? We do have a special asset have negative beta. Negative beta, which means it has a negative relationship as the market, which means when market condition is good, this stock or this financial asset decrease or return decrease. When market condition is bad, such financial assets return increase. Do you guys know what asset is it? It's very easy. No. I didn't think about it, but I don't think so. Yeah. Last week I bought Tax Lotto, but don't worry about it. All right. Let me see it again. We do have negative beta asset. I'll give you one classical example. Negative beta means what? Negative beta means if the market condition is good, market return increase, you will have negative return. If the market condition is bad, market condition or market return decrease, you will have positive return. What asset is it? Very easy. What asset is it? What asset is it? Gold. Gold. If the market condition is bad, market return decrease, gold price increase. If the market condition is good, gold price decrease because no one invested in gold. Does this make sense for you? Okay, but don't worry about it. This is, the negative beta is not in our discussion, okay? Up to this stage, any questions? All right. Now, that's step one. So step one, we measure systematic risk of the asset. Once we are able to measure systematic risk of the asset, step two is very easy. What is step two? For step two, all you need to do is now you know the relationship between expected return and systematic risk. Then, by observing the movements of market return, you're then able to observe the movements of your stock return or estimate the movements of your stock return. Does this make sense for you? Up to this stage, any questions? Okay? Now, that's basically everything about the risk-based approach. Now, let me say it again. For this risk-based approach in finance, all we are trying to do is to identify the relationship between risk and expected return. Specifically, we're trying to explain the risk and return relationship. That is, if market return increased by 1%, what happened to your stock return? That's what we want to know. If market return decreased by 1%, what happened to your stock return? That's what we want to know. Does this make sense for you? That's what we want to know about your risk and expected return relationship. We are using historical data. We are trying to identify the relationship, but that's it. We cannot use this method to predict the return. No way. Some students may be wondering, hey, Robert, if I know systematic risk, which means as long as I know the expected return of the market, I am able to work out tomorrow's return for my asset. And that's some of, with all the due respect, in some universities, some of the lecturers may teach their students in this way. This is entirely wrong. Why? Because if you want to predict return, yes, you can use this risk-return relationship, right? But you have to know the expected return of the market in future. But how do you know the expected return of the market in future? You may know a general direction, right? Go up or goes down. But to what extent, you have no idea. So all this relationship here, I am trying to teach you a method. Understand the relationship. What about if market move up by 1%? Okay, then my share move up by 1.4%. That's it. What about if the market move up by 2%? Okay, then my share move up by 2%. That's it. But what is your share return tomorrow? I don't know. No one knows. Does this make sense for you? All right. Once we know the risk-based approach, historical data purpose, we are then able to work out expected return based on historical data of all of the financial assets. Now, intuitively, the next stage, I will talk to you and explain to you something about portfolio return. In practice, last week, as we probably discussed, it looks like we should not invest in individual assets. Am I right? If we should not invest in individual assets, how does the expected return of a portfolio related to the expected return of security in the portfolio? In short, if you know the expected return of individual assets, what is the expected return of a portfolio, hypothetically? And how do we determine this? You may have reasonable estimations, and you may need to make estimations. If this is the case, we are using a method called weighted average method to work out expected return of the portfolio. What is a weighted average method? Weight of your asset in the portfolio times its expected return, plus weight of the asset in the portfolio times its expected return. Does this make sense for you? For example, if the expected return of asset A is 5%, the weight of asset A is 20%. Expected return of asset B, 10%. The weight of asset B, 80%. A plus B, sum of the weight must equal to 1. So you only have 2 assets in your portfolio. Am I right? Do you agree? then what is the expected return of the portfolio? 20% weight of A times 5% return of A, which is 1%. Plus 80% times 10%, which is 9%, 8%. Sum it together is equal to 9%. So the portfolio expected return will be 9%. We have more examples coming soon, all right? Up to this stage, any questions? Any questions? All right, and that's how we estimate portfolio expected returns. It is using the expected return method. The portfolio expected return equal to the weighted average of portfolio asset expected return. Portfolio expected return, ERP. R standing for return, E standing for expectation, P standing for portfolio. So E standing for expectation, R standing for return, P standing for portfolio, is equal to weight of the first asset, times expected return of the first asset, plus weight of the second asset times expected return of the second asset, plus weight of the number nth asset times the expected return of the number nth asset, etc., etc. That's how to work it out. Up to this stage, any questions? Any questions? All right. If this is the case, or if there's no further questions, let's do one example. Initial investment, $10,000. If $3,000 invest in asset A, $7,000 invest in asset B, then what is the weight of A and B? So initially you have 10,000 in your pocket, right? 3,000 invest in A, 7,000 invest in B. What happened? The weight of A must be, yes, must be 30%. The weight of B must be 70%. Okay? Let me see it again. Sometimes students ask me, hey Robert, in this case, how could you have an expected return of share A and expected return of share B? You have this, you are estimate the expected return by using the systematic risk and return method. That is based on your estimation about future market condition. Everyone's estimation could be different, okay? But you are estimating this expected return by using the risk and return relationship. Now, expected return of A is 10%. Expected return of B is 5%. You have the weight, you have expected return. Are you able to work out the portfolio return? How much is it? Weight of A times expected return of A plus weight of B times expected return of B. Do you agree? Am I right? So basically, the expected return will then be 30% times 10% plus 70% times 5%, which is about 6.5%. Which is about 6.5%. Up to this stage, any questions? Any questions? Very good. Now, if there's no question, let's move to the next example. Let's do it one by one. Can you see the table in the back? From the back, can you see the table? The figure in the table? Let me try whether I'm able to enlarge it. Okay, I think this works. Okay, are you able to see it from the back? Okay. All right. We have 4 shares, right? Telstra, Billabong, Woolworth, and Cochlear. 4 shares. For these 4 shares, as you can see, based on our risk-based approach, we work out the expected returns. The expected return is already given. ER is given. And you also know the amount of money you actually invest into each one of the share. The question is, this question asks you to work out what? To work out the portfolio expected return. Question 1. For Telstra, Billabong, Woolworths, and Cochlear, in the third column, do you know the total amount of investment? Are you able to work out your total amount of investment? Very good. Total amount of investment is equal to 2,500 plus 5,000 plus 2,500 plus 10,000. Am I right? 20,000. Once you have total amount of investment and you know the amount of each of the investments, are you able to work out the weight of each of them? Are you able to work out the weight of each of them? So you work out the total, you work out the weight of each of the investments. Do you agree? Once you work out the weight of each of the investment, the sum of the weight must equal to 1. Are you able to work out the portfolio expected return? Weight times corresponding return, plus weight times corresponding return, plus weight 3 times Woolworths return, plus last weight times Cochlear return. You will then have expected return of the portfolio. Do you agree? Up to this stage, any questions? Any questions? And that's how we work out expected return of portfolio. So step 1, from the very beginning, what we've discussed, for each of the individual assets, we're trying to identify its risk and return relationship, which is called the risk-based method. In the second half of the lecture, I will teach you capital asset pricing model to formally apply it or estimate it, right? Step 2, if you want to work out risk and return relationship, as we all know, we do need to consider systematic risk. Step 3, as we all know, we cannot calculate systematic risk of each of the underlying assets. That's impossible. Step 4, we then decide to make an assumption. What about, let's assume the market systematic risk is equal to 1. And then we work out a systematic risk, which is a relative risk measure. The systematic risk of your company relative to the market, based on historical data, by using regression, right? And then step 5, once you have such a relationship, let's work out expected return. To work out expected return, now as a financial analyst, you need to apply your own knowledge, your expectation about future market condition. Some of the analysts believe in tomorrow the market return could be 8%. Based on this, worked out your expected return of the assets. Some of the analysts may estimate future market condition is 10%. Based on your estimation, you work out your expected return. But for each of the individual financial analysts, by theory, in practice, your return for underlying financial assets will be different. That's why in the market we have buy and sell. Get it? And finally, step 6. For each of the underlying assets, by using your knowledge, your experience, your prediction, or your experience and your method, you are able to work out expected return for each of them in your portfolio. You then have the weight of the portfolio. You then work out the expected return of the portfolio. You then present your portfolio to your customer. Does this make sense for you? That is the whole idea about financial investment. Another practical example, for your superannuation, if you decide to stay in Australia, you will have superannuation. And for your superannuation investment, your financial analyst or your financial planner will ask you to select how much money you would like to invest in cash markets, share markets, bond markets. These are called asset allocation, weight of the asset, weight of your investment. For example, in my case, I'll allocate 50% on cash markets. I'm kind of risk averse. 25% on share markets, 25% on property markets. So the weight of these 3 asset classes will be 50%, 25%, 25%. And then I will have an expected return of each of the assets. And then I will have an overall expected return of my superannuation portfolio. Does this make sense for you? And when you talk to your financial planner, they will present you with something, and that's how they work it out. But of course, with their expertise, with their knowledge. But of course, it might not reflect what really happened in future. They may told you that in next year, your superannuation expected return could be 10%. In fact, it could be 7% or 15%. Okay? Up to this stage, any questions? Very good. All right. Let's talk something which is very interesting. But before we move to next slide, let me ask you something. Okay, let me ask you something. Today, I have 3 assets in front of me. Listen carefully. 3 assets in front of me. Asset A, asset B, asset C. A, B, C, okay? For asset A, based on my estimation, its expected return will be negative 10%. Negative 10%. For asset B, based on my estimation, its return will be 20%. For asset C, based on my estimation, its expected return will be 5%. So negative 10, 20, and 5%. Question, if you want to make portfolio investment, how many assets should you include in your portfolio? 3, 2, or 1? Let me see it again. Asset A, negative 10%. Asset B, 20%. Asset C, 10%. Let's assume all of them are fully diversified. So only systematic risk left. 3 of them. If you want to make portfolio investments, how many assets should you include in this portfolio? Ah. See, we have different opinion. Now, who said 1? Why do you think it's 1?
When the structure is safe and I'm getting 20% return, that is more than.
So from your opinion, if I invest everything in the second asset, I will have 20%. Right? Expected return 20%. But of course, higher systematic risk. Higher risk, higher return. Do you agree? So that's his approach. Some students said, okay, I should go for B and C. If you go for B and C, your return will be somewhere between 5% and 20%. Do you agree? And in this case, you have slightly lower return, but because you include C in your portfolio, the overall risk of the portfolio decreases as well. Do you agree? Some students may be wondering, I should go for C only because I'm super risk averse. I only invest in C. Who said 3? Why?
Because I'm diversifying my risk and return.
They all were diversified. The first asset is negative 10%. They are fully diversified. So all of them are fully diversified. You don't need to worry about diversification. I'm just talking about from the return-wise. Question, if you only consider from the return-wise, should we include A in our portfolio? Yes or no? That's the first question. Second question, if you only have these 3 assets, listen carefully. Negative 10%, 20%, and 5%. If you only have these 3 assets, are you able to reach a return that is higher than 20%? Huh?
Yes.
How? How? You don't worry about diversification, okay? How? My first question I will ask you, if you have 3 assets present in front of you, should you consider all 3 of the assets? Second question, are you able to reach a return which is higher than 20%? Now, think about it. We will come back to this question, all right? I can tell you the answer. The answer is yes and yes. But I will show you later about how, okay? Let's have 15 minutes break. Please come back at 1:10, okay? Yes.
think that you are considering the purchase of a share of BHD and you expect to pay $1 dividend in 1 year. You believe that you can sell the share for $15 at the end of the year. If you require the rate of the return is 10%, what is the price of your will be? Yeah, what happened? Yeah. Okay, I will show you. So if your required rate of return is 10%, what price would you willing to pay for this share today? So basically, what does that mean? You expect to pay $1 dividend in 1 year. So you will receive $1 dividends. That's your cash in 1 year's time, right? So in time one, you will have $1 dividends. And you will also have $15 of the selling price, 15 share, right? So at the end of the year, how much is your total cash flow? $15, right? Now your expected return is 10%. So over that year, you want an overall return of 10%. Now how much money you are willing to buy at the beginning of the year? It will be, that's it. It's no formula. Where did you have this question though?
Do we have this question before? I think it's slightly different, isn't it? I don't know, just let me show. I'll show you. Yeah. In this example or in the workshop? Lecture slides or workshop? It's here? Is this the one? Oh, it's quite messy, yeah? That's how I'll show you. Just give me a second. Oh, quite messy. Just 1 second. Yeah, that's how to work it out. That's exactly what I show you. That's how to work it out. 16 divided by which is will be 14.55. So basically, no, this logic is very simple. How to create this equation here? This logic is very simple. Think about it this way. So this question is asking for P price here, right?
In the exam, I can just do it. I need to.
There's no such equation or something. You need to understand the logic behind. But anyway, that's the cash flow you have at the end of the year, right? This is the price you are willing to pay, right? This question is asking you for a given price that you are willing to pay, and you want a 10% return, which means the price you are willing to pay times 1 plus 10% will give you $16. So that's how it gives you 10%. So if you have 10% of the return, you will then have overall $16 cash at the end of the year. Then what is the price? So price times 1 plus 10% is equal to $16. So price will equal to $16 divided by 1 plus 10%. That's how. I think it's the same thing. You can try to do this question and come back to me. But I think you want the same thing next year. After receiving the second dividend, you sell it for, if you are required to return is 10%. So for this one, it's the same thing. Basically, that's what happened. So after the share will pay $1 dividend next year, so $1 dividends here, and $1.1 dividends here, and also $16 here, right? And if your required rate of return is still 10%, what is the price of end of first year? So what is the price here? And what will be the price here? Divided by 10%. Here will be this one, let's assume is T0, this one is T1, right? T1 will be T1 times 1 plus 10%, because it's 1 year, right? Is equal to $16 plus $1.1. So you can then work out T1, right? Once you work out T1, on that year there's $1 dividend, right? P0 is then equal to, or P0 times 1 plus 10% is equal to P1 plus $1. And solve it, okay? Yes?
Standard deviation.
Yeah.
The unit is very interesting. I like it.
Okay, that's good.
Standard deviation, from my understanding, standard deviation is basically trying to minimize the risk, is it?
Not equally. Standard deviation represents the total risk.
Standard deviation.
Standard deviation represents the total risk of the asset.
diversification is helping you to eliminate unwanted risk. None of the method is trying to minimize risk.
Which one is
None of them is minimized. I didn't teach you anything. Why should you minimize risk? If you minimize systematic risk, means lower return. So lower risk, lower return. Why should you minimize?
So what way we standard deviation?
Standard deviation is the total risk. Total risk of
Okay.
assets.
Okay.
Why is standard? Because we want a measure of total risk. So standard deviation measures total risk.
If the value of the standard deviation, when you get if the figure is higher,
It means total risk is high.
total risk is higher.
It does not necessarily indicate return is high.
I understand. So if the value for the standard deviation is high, the total risk is high. If it's low, the total risk is low.
Okay. That's standard deviation. But that's it.
It's very interesting.
Alright? Why do you need to? How? Oh. Why you do another spot can happen? Huh? Oh, get your point. So,
I just want to make sure I was
well, first of all, let me. You don't need to present. You don't need to present your assignment.
what I was going to.
Why?
Your second discuss as one of the
Okay. Okay.
that's why it's
Okay. Yeah.
and
Yeah.
it's not hard.
Yeah.
But I'm just wondering right because I just use
It's the same. Function and regression is the same. But I prefer to use regression because it's giving more information. In addition to giving more information. But it's the same. It's looking the slope is the coefficient. It's the same.
huge difference. Considering, it's about 6 times. Which intuitively I couldn't understand. I couldn't understand why it was so different. Because what you're saying up there was basically the outcome of the market.
The reason is because if you run the regression, the reason is because you're using annual data. It's multi-data. So what you don't understand is like this is for how many months? This is for how
3 years of monthly data.
What about this?
Also, they're all the same. So I think the all winners data will not change. Just what you said before.
Yeah.
All those stocks.
Yeah.
All is a monthly return.
And those are 3 year data.
Yeah, so 3 years.
For 3 companies, yeah.
Yeah, so 36.
Yeah, so why you think that, what's your question? You think they are,
We'll say.
but they are 3 different companies, yeah.
Yeah, 3 different companies. But you say went up.
Yeah.
100%. These went up 100%.
Yeah.
Yeah, the bigger is below 1.
No, that's impossible.
That's why I'm wondering who actually calculated it correctly.
Because, look, beta is, there is a possibility, because you are using months data, there is,
I'm not using annual.
I'm thinking, so what you are trying to say is like, if you look at the price, for 3 years time, one share, the share price goes from $1 to $5, the market is from $1 to, for example, $2. And, but the beta is very close to each other, even lower.
It's not just lower. 10 years of monthly data, and I'm getting very strange. And then I'm looking at the beta calculation of the other clients, and so they're different. So I'm just taking how they do. I think they're doing it US market. But I just it just intuitively didn't make sense. What I'm saying before, you terms of what I'm seeing.
I have the answer for this, but what should I say?
Up and down.
No, I have.
There's,
I get your
what
point.
I know
I'll
is
tell you something.
there are some that have higher upside, but not so much. So when the market goes down, someone does. It doesn't go down as much.
I'll tell you something. All right, I'll give you a hint. I'll tell you something. Because you need two methods anyway, right? You need two methods for the second sum, but I don't know time. So use this method. I'll let you know why the reason. The reason I think I know the answer. Basically, what happened is like in about 50 years ago, we think that the stock return is only dependent on market factors. That's why we only have a beta. So we assume, like you said, if the market goes up, you goes up by you should goes up by a lot of degrees. At least moon shouldn't be more, right? But later on, we realized, in addition to the market data, or in addition to the market factors, the stock price is also determined by the size and HML, the book to market value.
Yeah.
So basically, this is SMB and this is so this is SMB vector, this is HML vector. This is the market value. So basically, your return, the reason that you have this mix is mainly likely because your return of the company is not only determined for the market, but also the size of the company. That's why. So your logic is right. Your explanation is all correct. Your explanation is all correct only if this stock is truly determined by the market. But in fact, in practice, it might be judged by size and HML. And there's one other factor which is called Kahar. Momentum factor. Okay, so this is the fourth factor that we have. So those factors, all those factors, they all affect the price. What I'm trying to do, arbitrage pricing model is another method you can use. But what I'm trying to explain to you is that there's other factors will affect those are all risk factors. Yeah. Those are factors that will affect price. What I'm trying to say is like you can present your result and discuss it and also highlight the limitation of pattern and then propose another method. That's what the method is. But to answer your question, that's the only reason. So if, see for example, if your price only given a market, if I goes up by $1, you goes up by $5, your beta must be positive and even higher than mine. But what about if your price is determined by market size, HML? Our relationship just between market or your relationship between is exactly your coefficient between you and the market is quite low, but you are mainly between the size and HML. That's the reason. Yeah, that's me. You probably try to think about this method, I think. But I don't want to go that deep. But this is very good. But I don't want to go that deep. But that's probably the reason. And in fact, in practice, Japan, because this is fundamental model, all the models are built on Japan. In fact, in practice now, only 3% of the market shares can be extended. And that's why most of them cannot be extended. Most of the phenomena you observe cannot be extended. Yeah. Thanks for that. No worries. Yeah, well, me about the start. Can you ask after this? After class? Yeah, after class, okay? All right. Wrong slides.
All right, let's start. Before the break, we've talked about my example, right? I told you there's a negative 10%, there is 20%, there is 5%. And I will ask you, first of all, should we include this negative 10% in our portfolio? Second question, from all these three assets, are we able to achieve a return that is higher than 20%? You guys told me no, but I told you yes. Why? The reason is because something called short selling. I will explain to you guys what is short selling. Basically, listen carefully. The weight of the portfolio have to add up to 1, right? But it does not necessarily indicate the weight of each of the assets in the portfolio must be 1 or must be less than 1. Let me say it, for example. If I have 2 assets, the weight could be 70% and 30%. Sum it together is equal to 1, right? But it does not necessarily indicate the weight of each one of the assets have to be lower than 1. In fact, the weight could be 130% of the first asset and the negative 30% for the second asset. Then you sum it up, how much is it? 1. And then some of the students may be wondering, however, what is this negative 30% weight? This is called short selling. Now, what is short selling? The short selling means a negative portfolio. It means instead of you buy long a portfolio, you sell a share. I'll give you guys a classical example. Listen carefully. In practice, for finance or for investment, we are using the word long and short. Long means buy, short means sell. Okay? But anyway, let me give you simple examples. See, for example, today, if you are a very good financial analyst, you are able to reasonably estimate all of the share price or return of the financial asset in tomorrow. Based on your estimation, you realize for this share, tomorrow it will have a negative 10% of the return. Now you have this knowledge in your mind, but how can you benefit from this knowledge? Are you able to buy the share? You can't. Even you know that it will have negative return, so what? You can't buy it because it will have negative return tomorrow, right? But what can you do? You can short sell. What is short sell? Today, listen carefully. You borrow share. You borrow share. And you sell it immediately today. And in the following day, you buy back the share and you return the share. Does this make sense for you? Let me explain. Let's assume the share price of the share today is $11. Based on your estimation, you think the share price of the share in the following day will be $10, right? So negative 10% of the return. Do you agree? So what can you do? Today, you borrow the share from the company, and you sell it immediately. How much money you will have in your pocket? Huh? $11, right? In the following day, you buy back the share from the market. If you are right, the market price of the share will be $10. You buy it back at how much? Quick, how much? $10, right? So what happened? You have $1 profit. This is called short selling. Does this make sense for you? For short selling, instead of taking a long position, a positive position, a buying position, you are taking a short position, a negative position, a selling position. Instead of have a positive weight in the portfolio, you have a negative weight because you sell the share. Does this make sense for you? Get it? I'll explain to you by using further examples. This is very interesting, short selling. All right? Let's see how it works with the short selling example. Okay? Now, before that, think about the second example. Think about it. Today, you do not have any money in your pocket. Nothing in your pocket. Now, there's 2 shares in front of you. For the first share, today, if you, based on your estimation, a share price today is $11. And in the following day, it will be $10. Okay? The second share, based on your estimation, a share price today is $11. But in the following day, it will be $12. Okay? Now, listen carefully. What can you do? You have nothing in your pocket. Step 1, you short sell the first share. You borrow the share, you sell it today. What happened? you have $11 in your pocket. Am I right? You have $11 in your pocket. Step 2, you move to the second share. You have $11 in your pocket, what should you do? You buy the second share by using this $11. Step 3, you hold it for 1 day. In the following day, what is the selling price of the second share? $12, right? You sell it. Then you have $12 in your pocket. Do you agree? But you need to return the first share. Am I right? What is the price of the first share? $10. You buy it back at 10, right? You have cash $12. You buy it back $10. How much is your profit? This is a classical example. In this case, what happened? You didn't pay anything. You have nothing. You didn't pay anything from the beginning. Am I right? And that is a classical investment trap in the practice. Back to 20, 30 years ago, a lot of investors using this method to make money, make profit, arbitraging profit. You don't need to have anything in your pocket. You just get arbitrage profits. Does this make sense? All right, so this is a classical example, but I will show you more and more examples about short selling and how to use it. So generally, short selling is a negative position. Instead of buy a share, you sell a share today. Now, let's see the example one by one. The first example, Rocket and Brackets. They currently sell for $10 and pay no dividends. You expect Rocket return next year 25%, and the Bricks will earn just 5%. Now, you have $1,000 to invest. So this is my Rocket. This is my Bricks. 25%, 5%. You have $1,000 to invest. To invest more in Rocket, what are you going to do? You think, look, Robert, Rocket 25%. 1,000 is not enough. Let me today sell some of the Bricks share. Let me borrow the share. So you decide to borrow 50 shares of the Bricks for 1 year. Let's see what's going on here, okay? So you combine the fund for selling the Bricks share with your own money to purchase. What happened? For the Bricks, today, sell for $10. Share price $10 each, am I right? You decide to borrow 50 shares of Bricks. 50 shares, you borrow it. You sell it immediately. How much money will you have? 500, am I right? How much money do you have at the beginning? 1,000, right? After you short sell Bricks share, how much money you have in your pocket put together? 1,500, do you agree? Yes or no? And all of these $1,500, what are you going to do? You buy Rocket share, right? How much is the Rocket share price? $10, right? How many shares you can buy the Rocket share? 150 shares, right? Okay, at the beginning of the investment, what is your position? You hold 150 Rocket share, and you borrow 50 Bricks share. Do you agree? That's your overall position at the beginning. Am I right? Let's say what's going on 1 year later. Let's say something amazing. What's going on a year later? First of all, what is the return of Rocket? 25%, right? If it is returning 25%, assume no dividends. The price now is $10. What will be your selling price? What will be your selling price? $12.5, do you agree? Am I right? Quick. Am I right? It's easy, right? Come on. This is very interesting. I'm teaching how to make money. If you don't like finance, you don't like money. Okay? What happened? $12.5, isn't it? For each of the share. How many shares do you have for the Rockets? 150 shares, right? Okay, let's do the calculation later. So for each of the share, now it's $12.5. But you borrow the Bricks share, right? You need to return its share. But it's only 5%. Then what is the share price? Return 5%, price now $10. What is the share price at the end of the year? $10.5, right? My position, 150 Rocket share, negative 50 Bricks share, right? Let's say how much money do I have in my pocket? In my pocket,
Let me enlarge it a little bit. Okay. Looks like I can't. Anyway, let's. In my pocket, what happened? Your rocket share at the very beginning, 1,500, and you borrow 500. A year later, you can sell the rocket share at $12.5 per share, 100 share, and you will have $1,875. Am I right? And you need to buy back 50 bricks share. You buy it back at $10.05 per share, or 50 cents per share. You buy back 50 share, you need to pay $525. Now, what is your overall net position? What is your overall net position? 1,350. Do you agree? Your overall position at the end of the year is 1,350. How much is your initial investment from your own pocket? 1,000. Then how much is your return over the year? 35%. Can you see that? Your overall investment return is 35%. What happened? If you only invest in rockets, your maximum return will be 25%, right? But by doing this, what happened? This is called financial leverage. You use borrowed money to make further investments. Now, some of the students may come back to me, hey, Robert, if this is the case, I should borrow the bricks share as many as possible and then all buy rocket share. Am I right? Please note, high risk, high return, low risk, low return. At the end of the day, all of those returns are based on your expectation. It might be right. If it is right, you have 35% of the return. Am I right? But what about if you are wrong? What about a year later, the bricks share increased by 25% and rocket share increased by 5%? What happened? You screwed up, right? And that's the short selling. And that's the risk of using leverage. Does this make sense for you? It certainly provides you with a technique to design your portfolio to reach your targeted risk and return. Sometimes, a lot of students think, okay, Robert, if I only have two shares, one is 5%, one is 25%, the maximum amount of return will be 25%. This is wrong. You can change your portfolio. You can design your targeted portfolio with your targeted risk and return. You can even have a portfolio return with 100%, but keep borrowing, right? But of course, on the other hand, you increase the risk. Does this make sense for you? So one of the beauty of portfolio investments, in practice, listen carefully. In practice, sometimes if you only invest in individual assets, you may not be able to find your ideal investment that meet your targeted risk and return. But for portfolio investment, you can design your portfolio. You can design a portfolio that meets your targeted risk and return level. Does this make sense for you? For example, if you are looking for a financial asset with a 20% of the expected return, in the market, there's no such an asset. But you can design a portfolio that gives you 20% of the return. For example, in the market, you are looking for something with 100% of the return. In the market, there's no such an asset except Crown Casino. But by portfolio investment, you can design such a portfolio. But keep borrowing, if you can, of course. Does this make sense for you? Up to this stage, any questions? We have one more example about short selling later on, but that's the beauty of short selling. But of course, let's take another look about short selling. Step by step. For the same example, initially we invest how much? 1,000, right? Now you borrow 50 shares. You borrow 50 shares, which means you have a negative $500 negative position. Am I right? And then you invest 150 shares. You invest 150 shares, put together, your total amount of investment is 1,500. Am I right? You want to know your portfolio return. Let's work out the weight of each of the investments. The weight of bricks
is negative 500 divided by 1,000, which is negative 0.5. Am I right? Or negative 50%. The weight for rocket, which will be 150%. Do you agree? The sum of the weight have to add up to 1. The sum of the weight, 1.5 plus negative 0.5 equal to 1. And you know expected return, weight of bricks times corresponding return plus weight of rocket times corresponding return. What happened? Overall, you will have 35% of the portfolio return. You can certainly change the weight. You can change the weight of bricks to negative 1, and then the rocket will be 2. And then you have higher return. You can even change it to negative 2, rocket will be 3. You have even higher return, etc., etc. But of course, you will have higher risk. What about if your estimation is wrong? Because no one knows about their estimation, right? Up to this stage, any questions? Good. All right. Oh. Generally, up to this stage, we've discussed a few things. At the very beginning, we've talked about systematic risk and return relationship. We talked about beta. And then we talked about portfolio return and portfolio relationship. Now, before we move to the next topic, I would like to show you something about how risky are emerging markets. Now, in this graph, as you can see, the first one is Russia, which is not surprising. And generally, what happened is, if you want to analyze Australian share, you are using Australian market as the base market, right? If you want to know the riskiness of emerging markets, let's have a global market index. Once you have the global market index, then for each country, its share stock or share market, you can work out its systematic risk relative to the global market. Am I right? Now, if you look at the emerging market, the global market, of course, is equal to 1, because beta of the market is always equal to 1. Am I right? Russia is twice as risky as the global market, and there's other markets which is higher risk. For example, Thailand. For example, Turkey. As we all know, political reasons, stuff like this. And just for your interest, you may want to know all those kind of things. All right? Up to this stage, any questions? Now, some of students come to ask me, hey, Robert, how come the Jordan market have so low, or the risk is so low? The reason is quite simple. For those emerging markets, with all the due respect, the market is too small. In most of the case, 99% of the market cap is dominated by the government-owned company, resources companies, and that's why it have low risk. If you look at Malaysia, their risk is quite low as well. Can you see that? If you look at Malaysia, the risk is quite low as well. And for students who are coming from Malaysia, if you look at the stock exchange, you should have known the largest companies from Malaysia is all owned by the government, right? So that's how it works. That's why it have very low risk, because of the nature of the business. All right, so just give you a general idea, lets you know. And same for China is the same. The largest 4 company in China is owned by the government. And those largest 4 banks owned by the government, okay? In fact, largest 10 companies owned by the government. So that's why entirely the risk is quite low. Up to this stage, any questions? All right, let's put everything together in the next slides. Okay, we've talked about portfolio return. Then what about portfolio risk? The portfolio return and portfolio risk share the same methodology. For portfolio return, first of all, you work out the expected return of each of the assets in the portfolio, then times corresponding risk, right? For portfolio risk, it will be the same. You work out the beta of each of the assets in the portfolio. You then times its corresponding weight. That's it. For example, in this one, similar from the last example, you have the weight of each of the company, and you have the beta of each of the company, and then you put it together, you work out the portfolio beta, still using weighted average method. So I don't want to spend more time on this. But importantly, it's about next topic. But before we move to next slides, let me ask you something. Last week, when we talked about return, I've talked to you something about risk premium. Do you guys still remember? Risk premium is the premium to risk, right? In fact, risk premium, it is the return that related to systematic risk because it is a premium or return reward for risk. Am I right? So listen carefully, when we're trying to explain the risk and return relationship, we are actually indicating the relationship between systematic risk and risk premium. Does this make sense for you? Now, let me ask you guys a question. Think about it, okay, and listen carefully. Today, if the market return is 10%, if the risk-free rate is 2%, how much is your risk premium? 8%, right? So this is my risk premium, 8%. Market return, 10%. Risk-free rate, 2%. Risk premium, 8%. Now, there is a financial asset in front of us. For this financial asset, based on our estimation, by using historical data, we realize that for this financial asset, its beta equal to 2. It means what? It means it's twice as risky as the market. Am I right? Now, listen carefully. It is twice as risky as the market. Question, what is the expected return of this asset? Is it 20%? Let me say my question again. This will be the last one I will ask you for this week. This is my market return, 10%. This is my risk-free rate, 2%. Risk-free rate is free from risk, offered to everyone. This is my risk premium, 8%. Okay? Now I have a financial asset. For this financial asset, I know its beta is equal to 2, which means this asset is twice as risky as the market. Am I right? Question, what is the expected return of this asset? Is it 20%? Is it 20%? Think, is it 20%? Do you agree? Beta is 2, which means it's twice as risky as the market. Am I right? Systematic risk only reward for the risk components. Question, for 1 unit of systematic risk, what is your return? 10% or 8%? For 1 unit of systematic risk, what is your return? 10% or 8%? It's 8%, isn't it? Because within this 10%, 2% of them is your risk-free rate. Am I right? So from the market perspective, for 1 unit of systematic risk, your return will be 8%. So 2 units of systematic risk, your risk premium must be 16%, am I right? But we haven't finished. For 2 units of systematic risk, your market return must be, your expected return must be 16%, right? But in the market, there is a 2% risk-free rate offered to everyone. Am I right? Then what is your return for this asset? 18%. Does this make sense for you? Not 20, not 16, 18%. Let me say my question again. The relationship is actually held between systematic risk and risk premium. Premium reward for risk. If market return is 10%, but risk-free rate is 2%, which means the risk premium reward for systematic risk is only 8% for this asset. Am I right? Which means for 1 unit of systematic risk, you will have 8% of risk premium. Am I right? Which means for 2 units of systematic risk, your risk premium must be 16%. And never forget about this 2% risk-free rate. It will offer to everyone. Does this make sense for you? If you pull it all together, if you understand what I'm talking about here, you then understand everything about this week's seminar. Because this is the great capital asset pricing model. Capital asset pricing model, first of all, you can use this model as one of your assignment last part method. This model, two things I would like to share with you. First of all, this model, now in practice, I have to be honest with you guys, no one uses this model in practice. Okay? At least no one uses this model alone in practice. Because the explanation power of this model is very low. All right? Or in short, this model is kind of outdated. Okay? But we still need to learn this model. Why? Because this is a fundamental risk-based model, the first one. Okay? How important is this model? In practice, we do not have Nobel Prize in finance. We only have Nobel Prize in economics. If you are a financial researcher, you have to compete with these econometricians or economics to get Nobel Prize. So from the finance discipline, in the practice, we only have 4 work actually won Nobel Prize in economics. And CAPM is the first one. So the capital asset pricing model by Sharpe and Linton in 1969 is the first piece of work winning the Nobel Prize in economics, because it is the first method trying to explain the risk and return relationship. It sounds easy now when I'm explaining this to you, all right? But back to 50 years ago, it's not that easy because they don't have computer, they don't have Excel, stuff like this. And they still need to reasonably estimate systematic risk and work out a method like this. And that is CAPM. And then we have an option pricing model in 1991. Then we have Eugene Fama won Nobel Prize 2 years ago, which is Fama and French model, 3-factor risk-based model, stuff like this. So just give you a little bit background knowledge about CAPM. So this model itself, it is not popular in practice. But this model is a fundamental model in explaining the risk and return relationship. Okay? So what happened? First of all, we need to consider a risk-free asset RF. Okay? For risk-free asset RF, its beta must equal to 1. Okay? Then we need to consider a market portfolio, ERM, expected return of the market. Question. If this is my expected return of the market, this is my risk-free rate. Expected return of the market minus risk-free rate will give you what? Market risk premium. So ERM minus risk-free rate will give you market risk premium. Second, for this market risk premium, what does that mean? It means for 1 unit of systematic risk, you will have market risk premium as your return. Get it? Let me see it again. If this is my market return, this is my risk-free rate. The difference between market return and risk-free rate will be your market risk premium. What is market risk premium? For 1 unit of systematic risk, because market always have 1 systematic risk, you will have market risk premium as your return. If your systematic risk is 2, your risk premium must be 2 times market risk premium. If your systematic risk beta is 1.5, your risk premium must be 1.5 times market risk premium. Does this make sense for you? That's it. So I will come back to these slides later, but let's look at this equation first. So what happened is the 2 asset portfolio lies on security market line. So basically, the capital asset pricing model is the equation that we can use to work out expected returns. If you look at this equation, I'll explain it step by step with you. Just match with our example. ERR is the expected return of what? Of your asset. RF is what? RF is a risk-free return for everyone. Am I right? Now, please look at this bit here. ERM minus RF is market risk premium. Am I right? ERM minus RF times beta is a risk premium for your systematic risk. Does this make sense for you? So your expected return of any underlying asset will simply equals to risk-free rate plus your beta times market risk premium. That's it. You can apply this equation to work out expected return of all of the underlying assets. If you are a financial analyst, you first of all trying to have a reasonable estimation about expected return of the market. And you then use your expectation about the return of the market to work out your expected return of the asset. That's it. Does this make sense for you? Is this equation hard, as previously discussed? So step by step, expected return of the asset is equals to expected risk-free rate offered to everyone, plus beta of the asset times market risk premium. That's it. Beta times the market risk premium is equals to the risk premium that's reward for your systematic risk. Does this make sense for you? Please note that sometimes the questions are very tricky. ERM minus RF is your market risk premium. Am I right? Sometimes the question may give you market return and risk-free rate. Sometimes the question may give you something called market risk premium and risk-free rate. If it's already give you market risk premium, don't get confused. It is not a market return. It is already take out the risk-free rate component. Up to this stage, any questions? Any questions? Okay. You can see ERM minus RF is the market risk premium. ERM itself is expected return of the market or market return. The questions tend to be tricky. Sometimes it gives you market return. If you want to, if it want to let you to work out the expected return of the asset, sometimes it gives you market return. If this is the case, you need to use market return minus risk-free rate to work out market risk premium, then times systematic risk, then plus risk-free rate, right? But sometimes the question may give you market risk premium. If this case, you just use market risk premium times systematic risk, then plus risk-free rate, that's it. So don't get confused. Market risk premium and market return, they are different. Market risk premium equal to market return, take out risk-free components. So as long as you see the word risk premium, which means you take out risk-free rate, that's it. Premium for risk components only. Up to this stage, any questions? Okay. Now let's move back to the last slide, the security market line. This line represents the securities or securities market line. Where is your portfolio on this line? I'll explain it one by one. Generally speaking, first of all, beta is what? Systematic risk, am I right? And expected return is the vertical axis. Your security market line always starts from risk-free rate. Because when beta is 0, your return is not 0. Your return starts at risk-free rate. Am I right? That's why it always starts at risk-free rate. It's not originated from 0. Does this make sense for you? Because when risk is 0, your return won't be 0. You have a risk-free rate. If risk-free rate is 4%, it started from 4%. If risk-free rate is 2%, it's originated from 2%. If risk-free rate is 3%, it's originated from 3%, but not from 0. Get it? Second, there is a positive relationship between beta and return. The higher the beta, the higher the return, because beta is a systematic risk measure. Am I right? Third, if you look at the portfolio, when beta is equal to 1, when beta is equal to 1, what happens to your return? Your return must be the market portfolio return. Get it? Because when beta is equal to 1, it means this is a market portfolio. Please note that beta is equal to 1 does not necessarily indicate it must be market portfolio. It can be any other portfolio. Any other portfolio that has the same risk and return as the market. Get it? So market portfolio have beta equal to 1, but beta equal to 1 could be any other portfolio. It's just any other portfolio have the same risk and return relationship as the market, mimicking the market. Fourth, the higher the beta, the higher the return. Where is B? B is return is higher than the market, right? But what about the return? But what about the risk? The risk is higher as well, right? Fifth, by theory, if CAPM works, if there's no other factors we need to consider for the risk-based explanation, then all of the portfolio should lie on the security market line. Not above, not below, should on the line. Because if systematic risk is the only explanation for return, for all of the portfolios, it must be on this line, am I right? But that's by theory. In practice, none of them is on this line. In practice, it could be above, it could be below, for many reasons. One of the reasons, as I told you guys, nowadays there's a lot of other factors will affect the return in addition to the market itself, in addition to market condition. For example, some of you guys may be using a model called cohort 4-factor model. Cohort 4-factor model is a momentum model. In this case, it's considered momentum. Momentum is more like a behavior stuff, behavior finance, because investors or their behavior, our investment behavior may be affected by our sentiments. There's momentum about the investment in addition to market factor. For example, there's other factors from my French. For example, arbitrage pricing model, stuff like this. Okay? But in this unit, just for this lecture, by theory, all of the portfolio should lie on the security market line. Question, what about D and C? It looks like portfolio D and portfolio C is not on the security market line. Let's look at A. A is on the line, right? Let's look at C. Let's compare A and C. What happened? For the given level of risk, so both A and C, they have the same level of risk. Am I right? Do you agree? A have higher return, C have lower return. Do you agree? Which means what? C is not well diversified. C is not well diversified. That's the only reason. Do you agree? Because C have the same level of risk as A but lower return. The only reason is because it's not well diversified. Now, or undervalued. What about D? D is above the security market line, which means it's performing better than any asset on the line. What happened? That could be arbitrage. But I will explain to you later. All right? We have more and more examples. Up to this stage, any questions? Okay. Now, generally speaking, for the security market line, is plus the relationship between expected return and beta. In equilibrium, all assets lie on this line. So if the market portfolio, or if all of the portfolio are well diversified, if the capital asset pricing model truly works and explains everything, in equilibrium, all assets or portfolio should lie on this line. But if individual share or portfolio lies above the line, its expected return is too high. The share is undervalued. It means today the share price is undervalued. You should buy. If it lies below, which means it's overvalued, you should sell. Okay? And that's how it works. Up to this stage, any questions? Some students may get a little bit confused about why it is undervalued, why it is overvalued. I'll give you one simple example. See, for example, point D. If point D is lie above the security market line, which means for a given level of risk, it has much higher return. If CAPM truly explains everything, there is only one explanation. That is, the share price today of the share is underpriced. Because it's underpriced, in the future date, when you realize the share price, or the share price being realized, you will have a much higher return than what it should be. Does this make sense for you? For example, if today's share price at a reasonable level, $10, In the following day, share price is $11. The return is 10%. It should be lie on the line. But what about today? The share price is underpriced. Instead of $10, it is only $9. In the following day, you can sell the share for $11, and then the expected return will now be like 17%. And that's why it's lie above the security market line, because today it is underpriced. It indicates that you should have buy. Okay? Up to this stage, any questions? And that's basically everything about capital asset pricing model. And I hope that you can use this model to work out the questions, to work out the expected returns. All right. Finance in practice. Do company use the CAPM? How often do the company use the CAPM to calculate the cost of equity? This is a survey. And generally speaking, surprisingly, there's still over 50% of the company always use CAPM. But please note that the reason companies still use CAPM because it's simple and easy to apply. In 99.9% of the case, they won't just use CAPM. They will use many cost of equity method, even dividend discount model. And they will then have the cost of equity from all of those methods. And then they will compare and contrast about their results. And then they will try to conclude the expected return of the underlying portfolio. Does this make sense for you? But just for the CAPM itself, recently the research indicated that its explanation power to explain the risk and return relationship is not strong. Okay? All right. Now, the next topic, I will spend about 5 to 10 minutes. Then we move to a workshop question. And the next topic is one of my favorite topic. Back to 10 years ago, at that point in time, I'm a tutor coordinator at Monash University. I had a student come to ask me, "Hey, Robert, why can't you just go to the market and make some money?" Yeah, I want to. I can't. Are share returns predictable? Let me say it again. In finance, I am not trying to teach you how to predict return. In finance, we believe no one can predict the return. Share price is not predictable. Share return is not predictable. We are not using the word forecasting or prediction in finance. We can't. In finance, we are trying to explain the risk and return relationship. We want to know what's going on. Okay? We do not try to predict the return. And that's entirely different from econometrician. Econometrician, they do forecasting. Okay? Why? Efficient market hypothesis. In 2015, Eugene Fama won Nobel Prize in economics. Efficient market hypothesis. The efficient market hypothesis arguing that in an efficient market, the prices rapidly incorporate all the relevant information. That is, once there's newly comes information, the share price should incorporate all of the relevant information. The market price is not predictable. In an efficient market, what happens is you and me, if you are an individual investor, I'm an individual investor, and even you are an institutional investor, we should all receive the same new information at the same point in time. But please note that when you have the same piece of information, we may have different predictions, or we may have different estimations. We may have different opinion. But efficient market means we will have the information at the same point of time. I'll give you guys one classical example. For example, last year, the election, Donald Trump, right, be selected as the president of the United States. On the election date, once you have the election outcome, all of the investors from the globe, they have this information together, right? Everyone knows he will be the next president of the United States. But we may have different opinion. Some of you guys may believe this is a good signal. Am I right? For example, in US, if you are in Texas, you believe this is good information for you. But some of people or some of the investors may believe this is a bad information. For example, in Wall Street, most of the investors believe this is a terrible news. And that's why we have different opinion. That's why in the stock market we have buy and sell. But most importantly, efficient market means we have the information at the same point in time. We then make our decision according to this information. And then the share price or financial asset price adjusts to this information immediately. Get it? It's not like you know Donald Trump will be the president of the United States 3 days ago, and then I will receive the information. This is called inside trading. Okay? We should always have the information at the same point of time. Does this make sense for you? And that's called information market, or efficient market. Market is all about information. Information, information, information. We make analysis based on information. We make our investment decision estimations based on information. In the efficient market, price rapidly incorporates all relevant information, probably even within 1 second. Now, it is much harder to create value through financial activities. It's much harder for you to create value just because you have better skills. At the end of the day, in the efficient market, what we believe, at the end of the day, your return is purely determined by the risk. Or, in short, how much risk that you are willing to take. Okay? And that's what we believe in the efficient market. Changes in asset price respond only to new information, and this implies that asset price moves almost randomly. So the change of asset price only responds to newly announced information. But right now, we have no idea about what kind of important news will be announced in the next 5 minutes. To this end, we have no idea to predict share price, because share price will move randomly. 5 minutes later, who knows what's going on? Am I right? What happened to the Turkey government? We have no idea. Last week, we thought Turkey government did a bad job, but for whatever reason, the Qatar government decided to give them money. And then the stock price reacts to this information. But what about this week? We have no idea. The price rapidly reacts to the news, but will only respond to the new information. Since you have no idea about the new information, the price moves randomly. But what is inside trading? You know something before others. And then you can do inside trading. You know what's going on with the stock price. That's inside trading. Get it? For example, if I am the CEO of the company, I am about to launch the financial report and key financial indicator, performance indicator of my company, but 3 days before that, I told you about my company's financial situation. So in this entire market, you are the only investor who knows about my company. And then you can make your decision. Am I right? To some extent, you can predict share price based on inside information. That's why inside trading is prohibited. But of course, in most of the country, people use inside trading. That is something which is really hard to prohibit it. But just give you a general idea about what are the key determinants of share price, and my market efficiency is important. Now, how do market become efficient? Price reflects information as a result of trading. Trader in position of information evaluate whether current price accurately reflects the information. In the market, there are strong incentives for large institutional investors to achieve superior performance. For example, yes, we all know in efficient market, blah, 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 blah. But in practice, things is not that easy. In practice, as we all know, first of all, large institutions, there is a possibility and highly probably they will have the information before you, right? Second, and most importantly, the speed of processing information. For large institutions, they may be able to processing the information and all of the information across the globe within 10 seconds. But you may need to proceed all of the information within 10 days as an individual investor. If this is the case, there's a difference, right? So that's why large investment institutions, they will make superior performance. That's why super wealthy people, they will give their money to investment bank. Because investment bank, they may have a bunch of good research team and keep tracking those information and keep grabbing the information. Does this make sense for you? If you watch a movie, people in Wall Street, they're trading every day. They have all those kind of things. Why they make tons of money? Because the speed they processing the information is different from you and me. First of all, they're waiting in front of the desk. They will be the first one receiving the information. And second of all is the speed, how they process the information. And that's why, traditionally speaking, those large institutions, stock exchanges, brokers, most likely they will have a higher return than individual investor. Because like you and me, see, for example, today, even you want to trade share, but you are now sitting in a lecture theater. You can't check share price and news. If something happened right now, you cannot receive the information and you cannot perceive the information. Am I right? And that's what happened. That's the limitation about individual investors. All right. The price of the share should always follow a random walk. Generally speaking, if the price falls yesterday, is it going up or going down today? Generally speaking, suppose the stock prices are not random and they are predictable. Someone who has such an ability to predict stock price can make an infinitely large amount of money. If this were the case, then small investor would never invest in stock market and market would not be developed. The efficient market hypothesis tells you market price depends on information. And then back to 30, 40 years ago, the first group of investors asked a question. All those kind of things are hypotheses and theories, but can we prove or can you prove the market is truly efficient? And then Eugene Fama gave this example. The market must be efficient. Why? Because as long as there are small investors still participate in the market, it means market is efficient. Because if the market is inefficient, if large institutional investors are able to consistently make profits, and then none of the small investors will be participating in the market because none of you guys will make money anyway. Okay? The advantage between, or the differences between you and large institutions is more like the speed of processing information, not about the information delivered to you in different days or something like this. Yes? Sorry, I didn't get the question. What trade? Well, that's why, that's because what we are trying to say here is stock prices follow random walk. You are right, that's why exactly the stock price follow random walk. At some point in time, see, for example, right now, you think you have enough information. Even you are a large institutional investor. Okay, even for example, you are a senior analyst from UBS or from Macquarie, or the investment bank, or Citibank. At this point of time, you think you have all of the information, and of course, the speed of you to process information is much faster than individual investors, right? But there is a possibility that in the next minute, something happens, something or new information comes out. Does this make sense for you? That's why the stock price is random walk. Because even you are large institutional investors, you are not able to get all of the information. That's okay. I will show you the next slide. You will understand what I'm talking about. I'll get your question, but let me finish the few slides. I'll come back to your question. So basically, that's the story. The story here itself is like, the stock price, if it's not random, if the prospect is predictable, then someone like the investment bank, if they are able to predict the share price, if this is the case, small investors like us, we will never invest in the market and there's no such a market. Because it's like gambling. If you know your opponent is able to predict your cards, you will never play the game with the opponents, am I right? If you want to have the market, you have to play in the same rule. Does this make sense for you? Does this make sense for you? See, if you go to Crown Casino, put about it in this way. If you go to Crown Casino, of course, Crown Casino, as a large institution, it has its own advantage. Am I right? Against you. But you're still standing for a fair bit of chance to win. Does this make sense for you? That's why we have the market. But I'll come back to your question. I know what you're trying to say, but let me finish the next few slides. There's one thing to answer your question. Okay, the movements of stock price from day to day do not reflect any pattern. So there's no certain pattern about day-to-day movements, but I'll come back to your question soon. So basically, this is random working evidence. What happened is, horizontal is a return on day t, and vertical is return on day t plus 1. So that's a relationship between your return today and tomorrow. And you can say there's no pattern at all. It's very random, right? Now, I think I kind of understand his question. but let me show you in the next few slides. So that's how it looks like. That's S&P. The relationship between return on VT and return on VT plus 1. So it's purely random. If you want to know more information, you can click the link here. All right. Now, all right. Sometimes, even the market is random. There is something called luck. And that is called hot can theory, which is very funny. What happens is, even if the market prices are random, there are still some lucky winners or hot hands. The lucky winner and hot hands means even if you are uniform and randomly pick a stock portfolio, you may outperform the market at a probability of 50%. Am I right? Because today, if you randomly pick up a portfolio, the probability of win and lose will be 50-50. Because it either goes up or goes down. Do you agree? Which means in the following day, it could still goes up and goes down. In the following day, it still goes up and goes down. If you are super lucky, there is a possibility that you are always right. There is a possibility that you are always right. You're just super lucky. See what happened? 1 out of 1,024 investors may be so lucky that he could beat the market index every year in 10 consecutive years. So 1 out of 1,000 investors, just purely by luck, you may be able to beat the market every year for at least 10 years. That's what happened. And that's why in the market, sometimes if you give your money to the financial investors, if you give your money to a financial analyst, financial planner, sometimes they beat the market in the past 4 or 5 years. You can't tell whether it's because they are truly good or this is purely by luck. Okay? But that's something to let you know. There's something called hot hand theory. It is hard to distinguish skills from good luck. All right? Now, and that's the random working prices of hot hand. I show you in these slides. 1 out of 1,024 investors can beat the market by chance in any 10 consecutive years. How many investors in the market? How many superstars to chance? We may have 1 million investors. If you have 1 million investors, you may have 1,000 superstars. All right, so you may have 1,000 people that are super lucky. They are able to consistently beat the market in the past 10 years. Okay? Now, let's come back to your question. So what you are trying to say is that if I am a large institutional investor, even I am standing for this point of time, I have all of the information, but I may not able to have all of the information. That's the overconfidence issue, yeah. Mm-hmm. Well, but my question is like, if the market is if the price is predictable, how can you make a mistake? The reason that you make a mistake. Yes. Mm-hmm. So what's the issue with this? Yeah, yes, you're right. Okay, I'll get your question. So what you're trying to say is, your argument is indifferent from this argument here, okay? Hey, where is it? Okay. Your argument is indifferent from here. So first of all, 2 things, don't get it wrong. Firstly, in practice, what do we know is that if there's no inside trading, if you are very active, see, for example, you just sit in front of the television and read and watching the news, 99% of the probability you will have the same information as large institutions, and you will receive the same information together with large institutions always at the same point in time. Do you agree with this? Assume there's no inside trading. If you sit in front of the television, you watch all of the news, you are indifferent from large institutions. Yeah, this is an assumption, but can we agree on this point?
But
Yeah, that's the first point, right? The secondly, if you agree on this point, as a large institution, your only advantage in contrast to small guy is because you can process the information quicker and faster, right? Can you agree on this? But that's one of the advantages, am I right? But you may make a mistake, right? And in this case, we do have the market, right? Even you process the information quicker and faster does not necessarily indicate you are right. Do you agree? And that's why we're still able to have the market. It's not fair, but we still have the market, am I right? But what is Eugene Pharma said here is, in this case, the reason we still have the market is because market price is random working. Even you as a large institution, as long as you don't always receive the information before others, even you have superior skills and knowledge, and you are able to process the information much faster, does not indicate that you must be right. You could be wrong, because market price is random work. And that's why we still have the market, do you agree? But what Eugene Pharma said here is, if the market price is not random working, which means someone can predict share price. If anyone can predict share price, then you won't make a mistake. And then there's no market. And that's the whole logic about this example. All right, I understand your question, but I can talk to you after the class, all right? And that's basically the most of the things we want to discuss about the efficient market. After we have the discussion about the efficient market, unpredictable asset prices and CAPM, and then students come to ask me, hey Robert, if the share price or return is unpredictable, then why should we spend time to learn capital asset pricing model? The reason is because capital asset pricing model helps us to understand the relationship between risk and return. We are not trying to predict share price. As a financial analyst or investor, all we want to know is to understand the relationship between risk and return. We want to take the rational risk and then have the risk premium. That's all we want. Higher risk, higher return, low risk, low return. That's what we want. Before we learn capital asset pricing model, think about in this question. There's two companies. One is high risk, high return. One is low risk, low return. But can you make your investment decision? Can you compare and contrast those two companies cross industry or cross discipline? You can't. But once you have a capital asset pricing model, you're then able to compare these investments to see whether both of them are on your security market line, to see whether both of them is underpricing, overpricing, or right under the line. And that's the meaning of the capital asset pricing model. Okay? CAPM offers a way to compare risk and expected return on investment alternatives. And that's the whole idea about this capital asset pricing model, not prediction. No one can predict. All right? That's basically everything for this week's lecture stuff. Up to this stage, before we move to the workshop questions, any questions? Any questions? All right. For this week, we only have one workshop question. But before we start, for those students who came late, let me say it for one more time. This afternoon, I'll have 2 cloud sessions for assignment 2. For these 2 cloud sessions for assignment 2, one is between 5:30 to 3:30, one is between 3:45 to 7:45. Now, both on-campus and off-campus students, you can join this class session. If you have any questions about assignment 2, you can join the classroom and type your question. I will answer your question. Get it? How to go to your class session? You go to your resources. You go to your resources. You click Cloud Classroom. And you click Blackboard Ultra, and then you can join the classroom. And that's how. Join the classroom at that point of time, and we can discuss about your assignment 2. And I will put or I will record in the discussions so you can watch my discussions. Does this make sense for you? Now, some students told me that they have class from 6:45 to 7:45. If you do have class from 6:45 to 7:45, could you please put up your hand, please? All right, two options. Option one, you can watch my recording video. If you think enough, that's good. If you only have one or two outstanding questions, you can ask your question Cloud Deacon or come to see me during my consultation time. Or if there's high demands about the questions or something, I'll probably open another session, all right, for a half hour or something to help you to answer these questions, okay? All right, we only have one workshop question about short selling. Let's do the question, and that's it for this week's seminar. So this question is very interesting. Similarly, about how we do short selling before, let's try to solve this question and think, be creative. Pete Paplo has 20,000 to invest. He is very optimistic about the prospect of two companies. So that's from Pete's perspective. He is very optimistic, right, about two companies, 919 Brands and Diaries. However, Pete has a very pessimistic view about one company, a financial institution known as Star Bank. The current market price of each share as follows. So based on his estimation, please note that all those expected returns are based on his own estimation. In practice, it will be always the same. Different financial analysts, different company, even different investment banks, they will have different perspectives about the expected returns of financial assets. So based on Pete's estimation, we have the price, and most importantly, we have the expected return. Now, if we do not have short selling, if we do not consider short selling, it looks like all we need to do is to consider the first two investments, right? Because if you don't have short selling, you can't buy the last one, right? The last one gives you negative return. Why should we buy it? But now, as we all know, we are able to do short selling, am I right? If we are able to do short selling, we are able to short sell the last one and to have higher profits. Then what should we do? So Pete, first of all, decided to purchase 210 shares of 919 Brands and 180 shares of Diary. What is the expected return on his portfolio? Can he make this portfolio? So part A is asking you, he will only consider to invest in the first two portfolio. He's only considering investing in the first two portfolio. But how much? 210 shares of 919 and 180 shares of Diaries. Question, do we know the share price of each of the share? Are you able to work out the weight of the investment? Are you able to work out the portfolio return? It looks like we can, right? Let's see what about part A. Do it one by one. So for part A, 919 Brands, share price 60. Number of shares 210. So total amount of investment must be 12,600. Diary, number of shares 180. Share price $80. Total amount of investment must be 14,400. How much is your total investment? 27,000, right? Are you able to work out the weight of each of them? You work out weight of each of them. Are you able to work out the portfolio return? Weight times corresponding return. Return is given. Return is 10% for 919, 40% for Diary. Are you able to work it out? So in this case, the expected return will be 12%, right? But please note that if you want to achieve this targeted return, how much money do you need at the beginning of the investment? How much money do you need in total? In total, at the beginning of the investment, how much money do you need? You need 27,000, am I right? Am I right? So you need 27,000 at the beginning of your investment. But how much money do you have? Do you have enough money? It looks like you do not have enough money, am I right? Okay, let's look at part B. If Pete sells short 100 shares of Star Bank, how much additional money you will have to invest into other shares?
You short 100 shares of Starbucks, which means you sell the Starbucks share today. How much is the share price? 70, right? If you short 100 share, what happened? You have 7,000. In the previous question, you need 27,000. You only have 20,000. Now, you just have this 7,000. Am I right? Okay, it looks like by short 100 share, you then able to what? Very good. Have enough money for the first investment. Am I right? Let's put everything together and see what's going on. You can do this practice by yourself again at home. Let's put everything together. Now, we buy 210 shares, 919, 180 shares of Diary, and then short 100 shares of Starbank. Let's see what's going on. So what's going on? You buy 210 shares of 919 brands. You buy 180 shares of Diary. You sell short 7,000 of Starbank. You sum them together. How much is your total investment? 27,000 minus 7,000 will be still 20,000, right? Are you able to work out the weight of each of them? Can you work it out? Summing together, weight must equal to 1, am I right? Once you work out the weight of each of them, do you know the return of each of them? Do you know the return of each of them? Are you able to work out the expected return in this case? Can you work it out? Weight times return plus weight times return plus weight times return. What is your expected return? What is your expected return? 19.18%. What happened? What is the return of each of them individually? And what is the expected return if you use portfolio investment? You have a much higher expected return. Do you agree? Now, there is one more workshop question, and you can do this question by yourself. It's a CAPM practice, very easy. Okay? So in this week, what we've learned, at the very beginning, we talked about risk and expected return relationship. We know that we need systematic risk. Then we use a beta method to work out systematic risk. Then once you have beta, capital asset pricing model help you to work out the expected return for individual assets. Then if you have individual asset expected return as beta, you can always work out portfolio return and beta. Then for portfolio return, if you have short selling, sometimes you may even able to have much higher return than individual asset return. For portfolio return, portfolio investments, you are able to have a return that meet your target risk and return expectation. And finally, we talk about market efficiency. Efficient market, share price, random walk. And that's basically everything for this week's seminar. All right? And please remember tonight's assignment 2 session. All right, if you can join tonight's session, please join and ask me questions. Further, if you have any further questions about assignment 2, make sure you ask it on Cloud Deacon discussion forum, because your question and our discussions, other students may benefit from the insights of our discussion. Don't send me emails. It tends like students always sending me emails to ask me questions. I want to share the questions. And second, and most important, today is 20th of August. There's only 2 weeks left for your assignment due date, right? If, unfortunately, you're still not able to find a group or something, please start your assignment by yourself at this stage. Don't wait and still looking for group partners. Just in case you can't find a group partner, you can still do it individually. Get it? And please make sure you sign up for a group. The group sign up function is open. Make sure you sign up for a group. Do you guys know how to sign up for a group? To sign up for a group, you click Tools, you click Groups, and then you select any group to join. If you decide to do it individually, you still need to sign up for a group, become a group of 1 out of 2. Okay? All right, I'll see you guys next week. If you have any questions about this week's topic
or even assignment or something, I will stay here for another 10 minutes. You can come to ask me. Yes. Huh?
I want to start online sharing.
What really?
Share trading. Share trading online.
What do you do?
Online securities of shares.
Sorry, I didn't get your question. What?
I want to start share trading online. Online.
Share really online. How?
Share. Purchase and sale of shares. Online trading.
Oh, you want to start online trading? Okay.
What is the best way to start?
Frankly speaking, in my experience, the best way to start it is to start from your own country share market. Your own country share market. That's the best way to start it. Because you have your relatives or parents in your own country, right? And this is important. You understand your country's market. You have a general idea of what the market is.
Already traded there.
Yeah, that's probably the best way to
I
start.
want to start in Australia.
Then you go to VSX. But why you start in Australia?
I just want to have exposure of
Australian share market is not can, but it's relatively stable, very low risk. Australian shares is only like, I think my perspective, it's only like this long term, like, for example, bank CBE or something is worth to hold.
which is more in terms of revenue return, which countries more volatile?
I don't know. How can I know? if I know how to if I know how to make a return, why should I say?
Short question. We ran this one. I am just concerned about the tax component in the foreign exchange. We talk about diversify, and certainly when we diversify by buying emerging markets in other countries, and obviously for a country like Australia, certain rate of non-foreign resident tax applies, which gets higher than the resident. So does explain take into consideration like foreign exchange effects in totality, or we just isolating the effect from foreign exchange?
You should also, I can't answer your question. I think it's more like a combination of both. It's really hard to answer between foreign exchange and tax. It's really hard to answer this. You need to put it into consideration. So basically what happens is like, if you want to ask me what to do,
Like I got a financial manager, and we
let me explain. First of all, the tax and foreign exchange, they have indirect relationship with diversification, with the risk of the business. So to this end, you should put it into consideration just for risk perspective. Second of all, tax and foreign exchange, it has stand-alone effect on your return as well. So you should also treat it as an independent factor as well. So it's more like in that way. Okay, so you have a pen. I can show you. Give me a pen. Do you have a pen? Do you have a pen?
no, that's okay. That's understood.
Okay. Yeah, you have a pen. I can draw a box to show you. It's much easier.
So probably next time.
That's okay. I can show you. No. 10 seconds. 10 seconds. I'll show you. So that is your risk about the business, right? That is your risk about the business. That's foreign exchange. That's tax. So this part of the foreign exchange and tax will affect your businesses. But look, this bit is standing alone effect. That's how it works. Okay. So part of them it will affect the risk of the business. It's related to your risk of the business. But most part of them is standing alone factor as well.
I know something like this one. I'm just recalling. I know something economics, but this part, yeah.
Okay. But that's all I can tell you.
No,
Alright?
no.
He's first here. He's coming first here. Yes.
I noticed this
Yeah.
when I see this beta is comparison with the AS600. Do you have any idea if this is a comparison with AS600 or the banking sector market?
I think it's 300. It must have explanation. I don't know. I didn't do research in the market, but I think it's as 300.
So if can you use this beta?
Look, my suggestion, you can Google it. Just Google. See, for example, Google Australian beta, how to calculate beta. Like this one, sometimes it has, when they have data, they should have explanations about the beta.
In other sites there is, but I found it in Yahoo, it doesn't have.
Yeah.
That's the problem.
But I think this beta is still against 300.
And
The PE ratio is against the industry, I think. This is a good question, but I think it's against 300. That's what I think.
so can this be used?
It's highly unlikely if it's against the industry. I never heard about it. P ratio is mass industry, but beta I think is against 400. If I make this assumption, that's okay.
So then there should be a good partner, or should I do with the formula? Because I think
It's up to you. It's up to you. If you want to use it in your assignment too, you can either get the data from here and explain to me this is data from here. And if you are able to figure out how to calculate it, that's very good. Otherwise, you make an assumption or something like this. Alternatively, you can calculate your beta by yourself. It's up to you.
this I'll try and calculating beta by myself. If I do it successfully.
Yeah, you can use this one. But the issue is, if this is beta, that even is against 300, but the issue is, do you know the sample period? You don't know the sample period, right? You have to figure out. There, I think somewhere, this website they must have explanation
So
for
what's
beta.
the problem? What period?
Sample period, because you have beta. How long is it 3-year beta, 10-year beta, or 100-year beta? You don't know.
So I'll have to use that.
That's what I'm asking you. I don't know what beta is this.
So I'll
But no, it's my experience. Because you click your one. I don't know because this is max. I think the max beta is still there, so this is max length. So at least 5-year data. I don't know. They must have explanation somewhere.
So I'll
Try to figure it out. Yeah, yeah,
I'll talk to you.
yeah.
Thank you so much.
Yeah. Try to figure out. If you can't figure it out, work your own one. If you can't figure it out, make an assumption.
All right.
You know it at least 5 years because you click 5-year data, it's still the same data, so at least 5 years. Okay? Yes. Yes. The expected return on particular share is 40%, right? So this is it, right? The share beta is 1.5, yes. What is risk free rate? The expected return on the market for total is 10%, yes. So yes, this is right. How to get RF? I'll show you. It's like 40% is equal to RF plus, you just times it 1 by 1 each, times 1.5 times 10% minus 1.5 times RF. That's how, which is 40% equals to RF plus 1.5 times 10% is 15%, right? Am I right?
Yeah.
Minus 1.5 RF. You agree? So, can I write it here?
Yeah, you can.
So you have 40% equal to RF plus 50% minus 1.5 RF. You move the 50% to this side of the equation is 40% minus 15% is equal to RF minus 1.5 RF. So it's negative 1% is equal to negative 0.5 RF. Alright? So if you divide this on the outside of the equation, RF is equal to negative 1% divided by negative 0.5, which is 2%. Okay? Yeah, that's okay. But you need to familiarize yourself with this because this is something very basic. You really need to do some practice. Okay? If you're not sure, ask me next lecture or something. Of course, I will show you. Compound method, compounding.
Okay.
So what happened is like, look, this is, you need to make your own assumption. First off, so you have interim and you have final. I know the interim and final sometimes they do the same day. But interim and final, which means in 1 year you have 2 dividends, right? Well, in fact, you practically paid on the same day. So if it is the case, you can make your assumption. However, this is paid on the same day, so I simply sum them together. But what about something is that interim is paid in the middle of the year? Final is in the end of the year. In this case, you need to compound the interim till the end of the year.
All of them are paid on
If it's paid on 60, I know in practice it's always stating that way, but you can make your assumption. But ideally, it should be interim and final.
Okay.
So you can analyze it. Well, you can argue in that way, however, I simply sum it up because it's in the same day. But ideally, interim is interim, final is final. If the data is not sure, normally we can make an assumption, interim is happening in the middle of the year, final at the end of the year. So for this year's total dividends, I need to compound interim till the end of the year by using the rate I give you and sum it together. That's it.
So guys are fully compounded or should we just add them and just tell you that yeah they
That's as I said. If you assume they happen on the same day, you can simply sum it up, add it, but you need to give me a reason why you add it up. If it's paid on the same day does not indicate it's actually declared. Data is showed on the same does not mean it's declared on the same day. You can make an assumption about declaration, yeah. But I can give you a tips. In accounting financial report, they simply sum it up. So you can tell me, hey, Robert, simply sum it up because accounting financial report simply sum it up, something like this. But you need to explain a little bit, okay, about your method. Whether you compound it or you simply sum it up, you need to give me a reason. Okay?
thank you.
Yes.
So, ABCD. So, how about the question? I'm not clear about adding to alternative opposite estimation method. What is it?
One is capital we learned today. Cost of equity is same as expected return. You need to do the research by yourself. That's why it's 12 mark. You need to search it. And I already give you a hint. One of them is CAPM, so you can search CAPM related article and search it. And another one, you just go to Google, type cost of equity. Just go to Google.
So, another question.
Yes.
I need to know the reference on it.
Yes. What question?
So, I need to put the formula in there or not? I just write it on Excel.
You just put it in Excel. It's okay. Just put in Excel. You can put one sentence in the sum. Said, okay, I'm compounding the interim dividends to final, and all the work should be in Excel. That's it. And then you show the work in Excel. You don't need to show me the equation.
Oh really?
Yeah.
Yeah, I just do in Excel and not explain anything.
Yeah.
So how about I explain?
No, what we're trying to say is, for this equation here, you don't need to show me.
Oh really?
Okay? You just need to show me one sentence. The company paid interim dividend for the half year, followed by financial dividend were paid at the end of the year. To this end, I will compound this final dividend, compound interim dividend to the final, and the works are shown in Excel. That's it. Okay, that's it. Or you show me this is okay. This is okay, but this equation is not necessary. This part is okay, but this equation is not necessary. All right?
Okay. So I just do the exactly 10 year from
Yeah. What?
20
Yeah. Read the discussion form. Yeah. I'll show you. Just give me 1 second. Read the assignment 2 discussion form. I think a student asked me a question before. I will answer this question. You can read this discussion form. Read this discussion form about the date. Yeah, what's your question? That's my answer.
Yeah. So this company which I choose for more than 10 years. So I just do exactly 10 years for report. Is it okay?
Yeah, exactly 10 years, yes. I only asked you to do 10 years, yeah.
Yeah, exactly 10 years, not more than 10 years.
10 years, just 10 years.
Okay.
You can do more if you want, but I only ask for 10 years, yeah,
Exactly 10 years.
yeah.
Yes, more than year.
Yeah.
Thank you.
No, yeah.
Yeah.
Any questions? Yeah. Okay. All good?
Vietnam.
Yes.
You know what I'm saying?
Yes, I know.
Have you found the fund?
Yes. Themselves, thing.
Why it's not G? Why it's not?
How hard accounting test on that? Is it good enough? It's really hard.
No.
And they take a short time to finish.
See. अरे मैं अपना इसमें कर रहा हूँ.
Why?
Don't share the same answer. Only like.
How to share?
No!
He doesn't want to spoil everything, right?
What's that?
I'm making new page just to give information to people what channel.
ILBJ comparison is all important information.
It's good.
Oh, okay. Okay.
Yeah, that's what I realized over a period of time. That
Why?
people
Why?
are really getting
Why
mindset.
to share with that?
Because it's where he wants it to grow.
Oh, yeah.
No, not business.
Not business. I say that I have an activity for
It's
the
only
year,
for
right?
the betterment of the betterment of people. Those who are sitting and those who want to know how things are.
Challenges, the difficulties they are facing, how they can come to Australia.
Who is admin for this? You?
Yeah.
Oh, really? Oh my God! Oh, good boy.
We have many such challenges. I just don't have to show easy, right?
So, do you finish the assignment?
Yeah, all done.
Already?
Yeah.
You finished already?
4 is done.
Oh, really? Okay. How about question E? How about
Which
question?
I saw in accounting.
No. Finance.
It's not questions.
Five questions.
No.
Last question you're talking.
No, we
Oh, really? So you.
I have started financial market assignment and I have done like 3,000.
So you have Facebook already? So not So you finish
I
accounting
just started financial market and I've written like 3,000 words. I have nothing else.
accounting how?
He has done accounting.
Sorry to ask you.
Really?
No, it's just shocking. So how for accounting, how about question 4? You finish?
Started accounting. I just finished my financial market. That's it.
No, but you need to. Yes.
Hang on.
Moon.
Hang on. Wait. Hang on.
Yeah. Moon, not on. Moon. Moon. Yeah.
Oh, that's how we can always see.
Yes.
That's how we can always see. If you want to know about the accounting assignment, so that we have done.
You done? Already? Oh my God.
submitted. You about to submit. She want to do question 4 of accounting assignment.
Yeah.
I will just show you.
You submit already? Yeah?
She is going to cut copy.
No, not copy. Yeah. How
We
could
write in
not
Chinese.
on yeah, I did it yes, yeah. Now.
We will submit in Chinese, right?
Huh?
We translate into Chinese language and submit.
Oh, really?
Which food is famous in Vietnam?
What?
Manchurian. Have you ever eaten Manchurian? Chinese noodles and Manchurian.
Mongolian.
Mongolian, Chinese.
Yeah, Mongolian.
Go round circle balls.
Yeah.
Yeah, that.
Oh, really? You like that?
Huh?
You like that? Mongolian.
It's Manchurian.
Manchurian.
Manchurian is known in India. I think it's known in Mongolian.
Yeah, I think it's Mongolian. Big Mongolian.
Have you eaten chili paneer? Reasons for
Chinese.
why the AS is concept?
Yeah.
You want this?
Yeah.
Reasons why ASSP is constituting the concept? ये अबे
Explain the advantages, how the reporting and ethical step.
matches her personality.
Yeah, so next question. Explain the reason why the AASP is considered. Yeah. Yeah. I just not
Not iPhone. Yes, iPhone, but this is
the iPhone.
No.
So this is Samsung.
No. This is not iPhone. This is iPhone. So
You
we
use
can't
Facebook?
Facebook, yeah.
Yeah.
Send on Messenger.
Same.
Messenger.
Yeah. Not here.
So what is the substitute for WhatsApp?
But it's not clear.
Dude, what is the substitute for WhatsApp? What is the alternative for WhatsApp in your country? How do you chat?
Messenger.
Messenger now. Facebook Messenger or in
Yeah, no.
WeChat?
No. Yellow.
Yeah. Oh, that's another app.
Not clear. I can't see.
I will send you a mail.
For email.
Yeah.
Is that okay?
Oh, he's happy.
Oh my God, good boy.
Alright.
Thank you.
Don't fall into that trap.
Wonderful. Thank you.
Got it? Don't fall into that trap. No, I don't fall into that trap. What she is thinking.
No, yeah, my email. Not copy exactly. Yes.
She is enrolled for the, you can enroll for the same course, Master Professional Accounting. Professional Accounting.
No, business. So,
Business management.
yeah, next semester I can from semester.
Next semester you came here to.
Yeah.
So why
My
do it
major.
now?